Sometimes the market is at an inflection point where it's hard to know whether it's more likely to go up or down. But this can be a good thing for options traders. Savvy traders can use options to profit whether the market goes up or whether it goes down, and within a broad range of prices. This video will teach you exactly how to structure such a fun and powerful trade. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City and proud to have developed numerous 7 and even 8-figure per year traders. Learn from the pros so you can grow your trading account.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And as most of you must have noticed, with the Federal Reserve having signaled that it intends to begin easing monetary policy in 2024, the S&P 500 index has returned to its all-time highs, which it hit last in early 2022, after which there was a sell-off for a full year, followed by a bounce in 2023, bringing us right back to those all-time highs in January of 2024. And so when an inflection point like this in the market is reached, where a previous high is tested, it's natural for experienced traders to ask whether this time the market is likely to break out to the upside like it did in late 2020 after retaking its all-time highs following the COVID crash, or whether the market will act more like it did in 2015, where after retesting its all-time highs 3 separate times, the market failed in a big way, selling off for months before partially recovering at the end of the year. And so in a situation of uncertainty like this, how can you capitalize on the ambiguity surrounding such a key moment in the market? Well, that's what we're going to be showing you in this video. In today's presentation, we're going to be sharing an option strategy that can make money whether the market breaks out to the upside or sells off and breaks down. You can win a handsome return either way using the strategy we'll be covering in today's video. Now, if you're absolutely brand new to options trading and you don't know much about options and how they work, we've created a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the strategy we're going to be sharing with you in this video. Then when you're finished, you can just come back and watch the rest of this video. Let's take a look at an analogous moment that happened pretty recently to demonstrate how the strategy works. All right, so you'll recall that in late July 2023, last summer, that the SPX index had rallied up to the 4,600 level, which you might recall from March of 2022 was a key level where the market tried to bounce back up to its all-time highs reached in January of 2022, but failed at that point and then sold off for basically the rest of the year. And so in July of 2023, the market hit that key level again, but as always, it's an unknown as to whether the market will again break down or whether it can break out beyond that level and march right back up to its all-time high. So let's say that on the morning of July 27th, which is when the market had returned to that key 4,600 level, you pulled up an options chain that expires at the very end of the year on December 29th, 2023. And you looked for a call option way above where the index is trading, 500 points above where the index is trading, which is 5,100, way past its all-time high. And you sell 10 of those calls for a price of $16.40. And you also search for an option 500 points below the index price, which is the 4,100 put, and you sell 10 of those for $41.05. And then at the same time, for protection, you went ahead and bought 10 of those 51.50 calls, which are 50 points above the short calls for a price of $12. And for protection, you also bought 10 of those 40.50 puts for a price of $37.05. And so when you do that, selling calls and puts closer to the index price and buying calls and puts surrounding those short options you sold further away from the market, when you do that, you've created what options traders refer to as an iron condor on the SPX index. And it's a strategy utilized by professional options traders all the time. Now, to begin to understand this strategy, let's first break down the cash flow implications of what we just done. And so starting on the call side, we received a price of $16.40 for those 10 5,100 calls. But remember, Index options pay off at $100 per point for every point that the index closes beyond the strike price of the index on the day the option expires. So you multiply that by 100 and you sold 10 of those. And so when you multiply it all together, you'll see that you would receive $16,400 for selling those 10 calls. But then you turn right around and spend $12,000 of that buying those protective calls up at 51.50 using that same kind of calculation. And then moving down to the put side, you can see that selling the 4,100 puts created positive cash flow of $41,050, while buying those protective 40/50 puts cost us $37,050, resulting, when you net it all down, positive cash flow at the outset of the trade in the amount of $8,400, for which your broker will require you to have at least $41,600 in capital in your account for you to be able to execute this trade in your online broker account, which is also the trade's worst case scenario loss. And if you don't have that much in your account, then you can simply cut back the trade's lot size to 5 lots or 2 lots or whatever to fit your personal trading account size, because all of the same principles of the trade are going to apply regardless of the number of options you buy and sell. Let's move forward to the end of the year on the day that this trade expires on December 29th. And as you can see, after initially selling off soon after we initiated the trade in late July, bottoming out around the 4,100 level, the index ended up staging a rally into the year end, blowing past that initial 4,600 level and closing the year at 4769.83. And so now that the options have expired, we can assign a final value to them, because on the day that options expire, they either expire out of the money, in which case they have zero value, or they expire in the money, which in the case of index options means that they have to make a payout under the options contract. And so let's analyze the status of each of the options comprising the Iron Condor, with the SPX closing at 4769.83. And as you can see, we start with taking note of the fact that we collected that original $8,400 when we first entered the Iron Condor, and then we move on to the 5100 call, which expired over 300 points above where the index closed at 4769.83. And the protective call 5150, of course, expired even further away from that price. And so those options have no value at all on expiration. They only pay off if the index closes above their strike prices, which it clearly didn't in this case. And for the exact opposite reason, the 4100 put, which is so far below the index's year-end closing price, and the protective put below that, which expired even further than that, both of those also expire worthless because they only pay off if the index closes below their strike prices. And so all 4 of the options comprising our Iron Condor expired worthless, resulting in that $8,400 in cash originally collected falling to the bottom line. And we just pocket that cash as our trade profit, which represents over a 20% return on the trade's original capital requirement by our broker, and that was in 5 months. All right, and so that trade was obviously successful, but there's a really important point for you to realize, and that is that this trade would have been successful actually over a very wide range of outcomes. Now, why do I say that? Well, think about it. With index options calls, they only have value if the index closes above the call strike price. At any price below that, the calls expire worthless. Conversely, puts only have value if the index closes below the put strike price. And so therefore, as long as the index closes below the lowest call, which is in this case the 5100, and above the highest put, which in this case is the 4100, then all 4 options expire worthless at any point in that 1,000 point range between 4100 and 5100. That's practically 20% of the entire index's value. That's a really wide range. And so what I'd like you to take away from today's video is that you don't have to be forced into making a decision about whether the market will move up through a key level or break down below it. You can make money regardless of which direction the market moves through the use of a properly positioned Iron Condor, as we just shared with you. Professional traders use Iron Condors as just one of the many option strategy tools in their toolbox, and now you can add this strategy to your toolbox as well.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window. So don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.